Well, stocks are rallying this morning as third quarter earnings season kicks off. We got a big week of economic data as well. The September Producer Price Index is out this morning at 8:30 a.m. Eastern. Economists are expecting a monthly increase of 0.2% and a year-over-year increase of 8.4% for the PPI. We are also looking ahead to the Fed minutes. Those will be out at 2 p.m. Eastern this morning. Joining me right now is Battlefin founder and chief market strategist Marc Lopresti. Marc, it's good to see you. Thanks very much for being here. What is your expectation for this week, whether it be earnings news or the economic data?
Well, good morning, Maria, and thank you for having me back on the show. Like most investors, we are looking primarily to tomorrow's CPI print. The market looking for about 0.2% month over month, and 0.5, half a basis point on the core, 8.1 year over year, 6.5 on the core. We really think the data tells us that we need to be at around 8.1 year over year to avoid another serious negative reaction from the market, possibly even at a 7.6. The problem is, I think we're not going to see those numbers, and we think that the print tomorrow could show that we are not out of the woods and even come in higher than expected, which is going to have the market ending the week down with more pain for investors, unfortunately. So
what do you think today is? A relief rally? I mean, the big banks are going to be kicking off the third quarter earnings season tomorrow. We've got all the major banks. They'll likely report a lack of IPOs, capital markets businesses under pressure. But we've been hearing about the banks reporting strong performances from the consumer. What does that look like, and what would you attribute this market rally this morning to?
Well, you know, we still have yet to see how the day ends, Maria. Certainly things look from the futures like we might have a day in the green. But as we've learned from these whipsaw markets over the past few weeks, we could very easily end in negative territory today.
Yeah.
And look, I'm of the opinion that the bank earnings and the guidance from the banks has been almost entirely too rosy. We've had a pattern with consumer spending that was almost frivolous spending during the summer, still sort of that revenge travel and spending on travel and entertainment. We're watching consumer credit card debt ticking at rates we have not seen since prior to the pandemic, $1.2 trillion, adding some $12 billion a month. When we last looked at that information from August, we think September is going to come in even hotter. Those factors have to start impacting not only bank earnings, but of course also retail.
Yeah.
And so when we hear the earnings from these CEOs, we're going to be looking to see what their guidance is as much as what the numbers were for the prior quarter.
Yeah, Mike Lee, jump in here as the IMF downgrades its economic outlook for global growth. The IMF now at a growth number, still growth, 2.7%, warning the worst is yet to come, Mike.
Yeah, Mark, it seems to me that the Fed is driving this entire market, and nobody really knows how far the Fed's going to go and what it would take for them to stop this aggressive stance. How far do you think the Fed is going to go, and what do you think it'll take to get them to change their mind?
Well, unfortunately, the most clueless among any of the folks watching this is the Fed themselves, right? I refer to it as the feckless Fed. Unfortunately, this is a Fed administration and under President Biden that I think is going to go down as one of the most inept in history. This action has been too little, too late. And I think if you look at like Kathy Wood's open letter to the Fed that was published yesterday, I don't always agree with Kathy on her individual picks, but I think she had a lot of really good and interesting insight in that letter to Jerome Powell. And I think, unfortunately, it's going to take the Fed realizing that they've gone too far. They've gone over their skis in being too hawkish, taking rate increases too far and seeing some real pain. But the problem is, Mike, this Fed has said explicitly they understand there's going to be pain in the employment sector. They want to create demand destruction to tamper down this inflationary environment. But I'm very concerned they're going to go too far.
Well, Mark, it's Dagan McDowell. Investors and speculators and gamblers, whatever you want to call them, need to wake up to the fact that the Fed's not going to be, based on what we've heard from Jay Powell and company, they're not going to be there to once again bail out all of those people. And you saw it over the summer that the buy the dip rally. Even the thinking, it changes. We need to jump in and buy a 20% dip instead of 30 or 50. And in order to break that psychology that's developed really over the last 20 years, the Fed needs to stand back and just say, we're going to just let investors feel the pain, because if not, then they will just be doomed to repeat the same mistake, and that's being at the ready with a bailout.
Yeah, I wish I could disagree with you. And investors have to be really careful about getting into the FOMO, the fear of missing out on these temporary relief rallies. On the other hand, right, as a lot of terrific investors have said, these are the times in which fortunes can be made. So you have to be looking carefully at the pricing of stocks that fit within some core themes, right? And we think things like the data infrastructure, with the absolute relentless explosion of data that's going to continue regardless of what happens with inflation or interest rates, things of that nature. When you start to see companies trading at or near their 52-week lows, as a lot of beat-up tech names have, and if you have a longer-term investment horizon, we don't recommend, not investment advice, but we don't recommend that people try to trade these markets. You have to invest in these markets for the long term.
All right, we will leave it there. Mark, it's good to see you this morning. Thanks so much. Marc Lopresti joining us.